dude, because that's what the theme of it is, right? Inversion theory. So first level of inversion theory is that interest rates have a positive correlation to financial markets. And in this video, we're going to unpack the fundamentals of that, right? So first, let's just look at the charts. The charts tell us the story, and then we have to make sense of that story. So the major story is, look at these uptrending interest rates during periods of bull markets. So 1993 all the way to 2000, you have uptrending interest rates. When the interest rates start downtrending, the markets crash, right? The dot-com bubble right here, this is that crash. The interest rates went way down right with it. You could say they went right down hand in hand together. So what's interesting is in the 2008 financial crisis, which began in October of 2007, that's when the market started selling off big time, October of 2007, the interest rates were already anticipating that major correction. The interest rates started downtrending in the summer of 2007. And it wasn't until the fall of 2007 that the markets took that specific downturn. All right, and then we look at the most recent interest rate cycle, market cycle situation, and we look at how they literally anticipated the 2020 crash, the spring 2020 crash, by even farther. Interest rates started downtrending in the summer before the spring of 2020. So in summer 2019, interest rates are coming down, and it wasn't until spring 2020, back in February, March, right around these parts, that the interest rates were almost at rock bottom. Now, it's really clear on this chart, on all the charts, on the major indices, that the markets anticipated the crash of spring 2020. Like, these all started selling off in February, right? A good month ahead, you had a gap down the third week in February to the fourth week in February. You had a gap down, like a massive one, right? And this thing didn't even look at where it bottomed here, right? Point I'm just trying to say is here, like, these markets anticipate these things. So make of that what you will. But then what anticipated those massive sell-offs in the markets were actually interest rates coming down after they had already gone up. So that's first level of inversion theory, right? Because everyone's saying that these rising interest rates, look at this sharp rise in interest rates, is going to cause the market to crash. Well, let's unpack the fundamentals of how inversion theory tells us the exact opposite of that is true, okay? So, who makes money when interest rates go up? Lenders? Banks, right? Who gets screwed? It's the people who are borrowing money. And they're not getting screwed. They're just paying. You got to pay to borrow money sometimes. So the banks are getting rich because they're the ones lending the money. So when the interest rates are going up, banks are going up. Now, what do banks also do? Well, they act as brokers, right? So they're specifically involved in financial markets as brokerage firms like JP Morgan, and all of these big Wall Street banks are the lenders. So when interest rates are going up, they're cashing in on that. So that right there is level one of why interest rates have a positive correlation in the market. If the brokers, the ones who are lending the money, the ones who are basically the gatekeepers between us, the retail investors, and the market themselves, as retail investors, we're kicking up to them. You know, if we're using margin, if we're doing anything like that, we're paying the brokers, we're paying the banks. The banks and the brokers are the lenders. That's, obviously, right? That's just specifically really important to see, because that's the fundamental argument of why interest rates have a positive correlation to markets. So it shouldn't be surprising at all that if you look at the JP Morgan chart, it looks exactly like the major indices, right? Why wouldn't it? Like, this is all the same situation. The funny thing is all of the markets look the same right now. Every market, if you go back to the top of the dot-com bubble, when that thing started selling off, they all look like this. They're all basically doing this very basic situation, this like 5-wave move off of this dot-com bubble bust. And that's like where we're finishing up here. So the thing is, if we're being conservative about these Fibonacci measurements, we don't even have to necessarily make the argument that JP Morgan is going to keep going up. We could just make the basic argument that on this chart, you definitely have a retracement coming in at some point. You're going to have a 702 retracement. Same thing with, NASDAQ, all the major indices. They're about to have some retracement after all this downside, right? But the big understanding is that there's a specific catalyst to cause that retracement to the upside, and it's the fact that interest rates are going up. And why is that a fundamentally good thing for the market? Well, because the market is essentially based on debt. So if interest rates are going up, then all market participants on average are kicking up more of their money that they're pulling out of the markets to the big banks. So the big banks who control the markets are making the most money in this moment where interest rates are going up. So look how easily this whole situation relates to cryptocurrencies. Well, we're talking about money and banks and things. The banks literally don't have a choice but to harmonize and synergize with cryptocurrency. They don't have any reason to start a battle or a war. So if they are going to most likely integrate with cryptocurrencies, they probably want to scoop up a whole lot of it, right? They want to scoop up as much as they possibly can. So why wouldn't they beat these markets down if they possibly can? Notice how as NASDAQ gets beat down, cryptos get beat down. Notice how Dow Jones is getting beat down. SPY is getting beat down. They're all getting beat down. What's the common thread between all markets? It's brokers. It's banks. Who's getting rich right now? The brokers, the banks. Who's about to cash in on raising interest rates? The brokers, the banks. That's why all of these charts have looked the same since 2000, because the brokers control the markets. So if interest rates are going up, we have a paradigm shift, which is cryptocurrencies, which have the potential to subvert the currency system as we know it, the fiat currency system. The banks obviously fully understand this. They know their best option is to integrate with the new technology, which is a currency-based technology. So that's why the NASDAQ gets sucked in here. That's why tech's all sucked right in here. The big banks have to deal with this. They have to accept this. So what do they want to do? They want to scoop up. Guess what? They control the markets. They beat it down. They beat this freaking thing to hell. They might beat them down some more. But why are they beating them down? Because they want to scoop it up. Because they want to harmonize and synergize with the cryptocurrencies. They don't want to be rendered irrelevant. You see all these connections. You see how interest rates have a positive correlation to markets. You see how we're told that they have a negative correlation to markets because that's the tools that the banks are using to beat down the markets so they can scoop up more cryptos and also tech because those are about to integrate. Brokers, banks, lenders, they control the markets. Interest rates goes up. Those brokers, banks, and lenders, they're making money. So if they're making money and they control the markets, well, then the markets are going to go up. And they also get to anticipate these sorts of things, right? So if they know that there's a giant innovative disruptor, that's going to pump the markets. Crypto is that giant innovative disruptor. And that's why I'm more inclined to think that the upside that we're going to see in the markets is actually going to be, significant. It could be more than just a retracement. We go back to the idea of from this current place on the NASDAQ, I think a really reasonable target is right about here. I mean, right? If all this stuff is going to synergize, if all this stuff is going to harmonize, that is laying the groundwork for a 1.618 based off of this structure, which is exactly what you're seeing in all major indices. They're all set up after an ABC correction, which is potentially a wave 4 down before a wave 5 up. What's the obvious place to go to if you have all these bullish reasons for these Fibonacci retracements to be respected? 1.618 seems obvious to me. We talked about the fact that what does the 1.618 represent? It's where the whales dump. The brokers, the ones who are getting rich as interest rates go up, the ones who control the markets. The other perfect alignment would have to be the US dollar, which is right up against this massive 702. It hasn't even reached the 702 yet, but the 1.618 based on this local structure is the 702 on this giant macro Fibonacci measurement I'm using that goes back to this peak. We're looking at that 702 on that structure before you're going to get some resistance. That's also the 1.618 on this tiny little local structure. So that could mean we have more upside coming in the US dollar, but look where it is likely to turn around with a high probability of resistance at this level. Align with the fact that the markets are 33% off their highs on average, because Bitcoin is dragging that average way down with it 75% off the top. You know what I mean? Like, these things are way down. Dollars right up at the 702. I mean, you would be foolish to go against the basic nature of this situation. You would be foolish to go against the dollar and its high probability of reversing at the 702, which is about 106 right here. You would be foolish to go against that. You would also be foolish to go against the fact that this is an extremely oversold market. On the weekly chart, you have bullish divergence on the weekly chart. So if I zoom in, you got crazy bullish divergence through this thing. But the fact that you can see the bullish divergence on the weekly chart, right? So you have a low and then a lower low. But on the RSI, you can clearly see, that you have a higher low in the RSI where you have a lower low on the weekly chart. That's anticipating you're about to come into some buying pressure. Now, we don't know how much that's going to take us up. I mean, we have to really zoom out and think in the long term here, because this structure is probably going to form maybe more like a W pattern of some kind, like a W to get up to that 1618, like ultimately a bearish pattern, something like this, you know, approximately. Something like this. So look at those time rate. You know, winter 2023, this thing could drag out till, right? Whatever. But it's not going to necessarily go up in a straight line. Like a W makes the most sense, but you might be starting to form that massively macro weekly W pattern. So obviously there's always volatility on the way up. But I mean, right now, you can see that it makes a lot of sense that we'd be starting the first leg of this W pattern. But that's why I keep drilling down on this and asking yourself these fundamental questions. You know, what's the fundamental driving factor of markets moving up when interest rates moving up? Well, it's the simple fact that banks control the markets, lenders control the markets. So lenders are getting more money for their money when interest rates are rising. So the lenders and the brokers obviously like higher interest rates. The markets like higher interest rates. That, to me, is as basic as it gets, right? It's the lenders. The inversion is just like, oh, retail investors can't participate because interest rates are going up and they can't afford to borrow money. Yeah, no, that doesn't make any sense at all, right? That's not... The disparity in the money between the retail investors and the banks is so stark that 99% of market participants don't even move the dial compared to 1% of banks who are just like, oh, let's send her up, let's send them down. So they're sending it down because they want to get the best possible deal that they can get on these cryptos so they can integrate, right? And it's really easy for them to beat down Bitcoin. You know what I mean? It's like really easy. They've set up a situation where like they've connected the cryptos to the stocks. Like all of the money has got so literally incestuous in Wall Street that those markets move in lockstep and crypto is moving farther with more velocity in whatever direction the major indices are moving. That's what we're seeing right now. And now we're seeing an uptick in interest rates, a really stark uptick in interest rates. I mean, I think the upside is more imminent than most people think, because I feel like nobody really sees the upside coming. One good news is they do tend to see the wave one if you zoom way in. I mean, I'm zooming on the weekly chart, but if you zoom in on this is obviously like the start of a wave one. What's the classic wave one behavior? No one thinks it's legit. So let's just see, right? You know, I mean, that happened here before. We did see this before, so that's why this thing could keep going down. Who knows? But the fundamental case is overwhelmingly bullish. So the price at this point, you know, the chart doesn't tell us everything, right? These prices are manipulated. I really think thinking more on the fundamentals is That's where you can get more clarity. And you got to be creative. You got to go against the grain. You got to realize everyone's wrong about interest rates. It makes sense that brokers and banks are controlling the markets and benefiting from raising interest rates. It just makes basic fundamental sense. So, all right. So you know where I'll see you guys. I'll literally see you next week.
Respect this process.